Welcome to the Mortgage Point Weekly Update, your fast, focused look at the biggest stories shaping housing, lending, servicing, and the broader economy. Once again, I'm your host, David Wharton, Editor-in-Chief of Mortgage Point and the 5-Star Institute. This week, we're looking at growing pessimism among single-family housing investors, a small improvement in home builder sentiment that may come with a pretty big asterisk, the latest numbers on mortgage delinquencies, and another sign that higher mortgage rates are putting the brakes on home sales. As always, we'll wrap up with a look at what's coming up in the week ahead. Let's get started. We begin with a look at a segment of the housing market that's feeling particularly pessimistic right now, single-family real estate investors. A new survey from RCN Capital and the C.J. Patrick Company found investor sentiment fell for the second consecutive quarter in June, reaching an all-time low since the index began tracking sentiment in 2023. Just 26% of investors said that market conditions were better than they were a year ago, the lowest share in the survey's history. Meanwhile, 45% said conditions had gotten worse, also a record for the survey. The concerns are familiar by now. Interest rates, rising insurance and home costs, limited inventory, higher renovation expenses, and pressure on rental rates. Jeffrey Tesh, CEO of RCN Capital, said that those factors are, quote, all contributing factors for their increased pessimism. And that pessimism is translating into less activity on the investor front. Real estate investors purchased 23% fewer homes in the first quarter of 2026 than they did in the previous quarter, and the same period a year earlier. 32% of survey respondents said they don't plan to purchase any properties this year, while only 9% plan to buy more than they did 1 year ago. Rick Sharga, CEO of the C.J. Patrick Company, said, quote, the high cost of financing is one of the biggest problems in today's market, unquote, with 3/4 of the respondents saying they don't expect rate relief anytime soon. Interestingly, however, there is still some optimism about prices. More than 60% of the investors surveyed expect home prices to rise over the next 6 months. So, investors may be pessimistic about the market without necessarily being bearish on housing itself. That's a pretty important distinction, and one that tells you just how much today's financing costs are changing the math for buyers. And investors aren't the only ones struggling with that math. There was a small piece of good news for the construction industry this month. The National Association of Home Builders / Wells Fargo Housing Market Index rose 1 point in August from 34 to 35. That beat economists' expectations for another decline. The index measures current single-family home sales, and it rose to 39, its highest level since May. But expectations for future sales and prospective buyer traffic remained unchanged. Interestingly, however, August marked the 16th consecutive month that builder sentiment has remained below 40, and that's the longest such stretch we've seen since 2012. The index also hasn't crossed 50, the threshold indicating that more builders view conditions as positive than negative, and that hasn't happened in more than 2 years now. NAHB Chairman Bill Owens said, quote, while builder sentiment edged higher in August, builders continue to contend with high construction costs and broader economic uncertainty, unquote. Neither are fuel costs helping. Gasoline is averaging more than $4 a gallon, while diesel is averaging about $5.45, nearly 50% higher than a year ago. Builders are responding with incentives and price cuts. In fact, NAHB chief economist Robert Dietz noted that August marked the 16th straight month that at least 30% of builders reported cutting prices to support demand. So technically, builder confidence is up, but this might be one of those up is still pretty low situations. The more important takeaway may be that builders are still trying to meet buyers where they are, with lower prices, incentives, and other concessions, while higher mortgage rates continue to limit what buyers can actually afford. Now let's turn to mortgage performance. The Mortgage Bankers Association says that the overall mortgage delinquency rate fell slightly in the second quarter, reaching 4.37% of outstanding 1 to 4 unit residential loans. That's down 7 basis points from the first quarter, but compared with a year ago, the picture looks considerably different. The delinquency rate itself is up 44 basis points year over year, while the percentage of loans in foreclosure rose 3 basis points during the quarter to just 0.67%. MBA's Marina Walsh said, quote, mortgage delinquencies decreased slightly across all loan types in the second quarter of 2026. Nonetheless, the broader trend is that both delinquencies and foreclosures have increased over the past year, unquote. That deterioration is particularly pronounced when it comes to serious delinquencies, those being loans that are at least 90 days past due or already in the process of foreclosure. That rate inched up to 2.06%. That's up 49 basis points from a year earlier. FHA borrowers are showing particular stress. The serious delinquency rate for FHA loans increased 227 basis points year over year. Walsh noted that some loans are continuing to move into later stages of delinquency, with serious delinquencies increasing for the fourth consecutive quarter. At the same time, the labor market has shown signs of weakening, while delinquencies on other forms of consumer debt, including student loans, credit cards, and auto loans, have also increased. So, the headline is that delinquencies have improved slightly from the previous quarter, but the bigger story is that the trend underneath that number is still moving in the wrong direction. For servicers and lenders, that's likely to remain an important watch point as affordability pressures persist. And if you want another indication of just how sensitive today's housing market is to mortgage rates, look no further than the latest pending home sales numbers. Pending home sales fell 2.3% month over month in July and 2.2% from a year earlier, according to the National Association of Realtors. That put pending sales at their lowest level since this past January. Every major U.S. region saw a monthly decline, while year-over-year activity increased only in the Midwest and fell in the Northeast, South, and the West. NAR chief economist Lawrence Yun said, quote, "The highest mortgage rates of the year hit right in the middle of the summer, and that's pulling back contract signings," unquote. He also pointed to record high home prices, saying that homes are sitting on the market longer and fewer buyers are bidding above asking price than they were a year ago. However, Yun does see a potentially significant reservoir demand waiting on the sidelines. Pending contracts are currently 30% below their pre-pandemic 2019 level, while payroll employment is 5% higher than it was then. First American senior economist Sam Williamson said that the situation comes down to some pretty basic math, saying, quote, "With mortgage rates rising again and home prices still elevated, the math simply got harder to make work when it comes to first-time and move-up buyers alike," unquote. Century 21 CEO Mike Meadler described the market as being stuck in neutral for months, with demand on one side and affordability constraints on the other. Is there a silver lining? There may be. For buyers who are in the market, conditions may be considerably less competitive than they were during that pandemic-era buying frenzy. More inventory and longer marketing times can mean more room to negotiate when it comes to repairs, concessions, and prices. So the housing market may be stuck in neutral, but at least some buyers are discovering that neutral comes with a pretty good parking spot. Before we wrap up, here's what's coming up in the week ahead, and there is plenty for housing and mortgage professionals to keep an eye on. Tuesday, August 25th, brings three particularly relevant reports. First, we'll get the S&P Totality Case-Shiller Home Price Index for June at 9 a.m. Eastern Time. That will give us another look at how home prices are holding up across major metropolitan markets. Then at 10 a.m., we'll get July new home sales, which should provide another read on buyer demand and how builders are navigating the affordability squeeze. We'll also get the Conference Board's Consumer Confidence Index for August at 10 a.m. on that same day. A weaker confidence reading could offer another indication that economic uncertainty is affecting consumers' willingness when it comes to making major purchases. Wednesday of this week is arguably the biggest data day of the week. At 8:30 a.m., the Bureau of Economic Analysis will release the second estimate of second quarter GDP along with corporate profits. We'll also get July personal income and outlays, which includes the Fed's preferred inflation gauge, the PCE price index. And the Census Bureau will release July durable goods orders. Then on Thursday, we'll get weekly initial jobless claims, which is another important read on the labor market. NAR will also be releasing their July pending home sales index, giving us another look at contract activity and whether the weakness seen in July is carrying on into August. Finally, Friday will bring the final reading of the University of Michigan Consumer Sentiment Index for August. So the big themes this week are pretty familiar: home prices, new home demand, consumer health, inflation, and the labor market. In other words, pretty much everything that the Fed and the mortgage market is watching right now. So to recap this week's headlines, housing investors say that today's combination of high financing costs, insurance expenses, and economic uncertainty has created their most pessimistic market in at least 3 years. Homebuilder sentiment slightly improved in August, but remains deeply negative when it comes to historical standards. Mortgage delinquencies declined from the first quarter, but serious delinquencies and foreclosures continue to rise compared with just a year ago. Pending home sales fell in July to their lowest level since January, as higher mortgage rates and elevated prices keep buyers on the sidelines. And this week, we'll get fresh data when it comes to home prices, new home sales, consumer confidence, GDP, inflation, employment, and pending sales. That's it for this week's Mortgage Point Weekly Update. We hope you'll subscribe so you don't miss any episodes, and also check out MP Access, our other podcast. This next week's episode will feature a familiar face. It'll be me. I'll be discussing everything you need to know about the 5-Star Conference, including some insights from my years of doing them many years in a row now, as well as who to look forward to, the programming, and everything else that you need to know about 5-Star Conference. That'll be happening September 1st through 3rd at the Omni Dallas Hotel, and we hope to see you there. Also, please check out themortgagepoint.com for all of our news and information on our events, webinars, news stories, and everything else you need to find right there at themortgagepoint.com. Thanks for listening. We will see you next time on the Mortgage Point Weekly Update.